Welcome to this Killick Explains video and welcome to part one of a four-part series on key investing decisions. And I guess the obvious one to start with is how much should we be investing? Now, it's not an easy question to answer. There's a little bit of subjectivity, but let's look at some guidelines in this first video and then we'll worry about other key investing decisions in videos 2, 3 and 4. So many people are not really sure how much to invest to stocks and shares. And the simple answer to that is as much as you can afford. History, whilst no guide to the future necessarily, no guarantee, suggests that equities normally do better than things like fixed income securities and normally do quite a bit better than things like cash. So the question then becomes, but how much of my wealth should be in equities? And I'm not going to put an absolute number on it in this video, that's going to vary, but I'm going to give you a framework just to decide what that amount might be. So the framework basically consists of a series of stages, if you like, quite logical stages. And in the current higher inflationary interest rate environment, as I make this video, paying down debt is going to be a key stage 1. Establishing rainy day emergency funds is going to be key stage 2. Identifying and funding foreseeable calls on capital, number 3. And then investing as much as we can of what's left as lifetime savings into, in a lot of cases, quite a high proportion of equities. Not 100% by any manner of means and not in all cases, but a high proportion to try and compound growth over the long term at the best possible rate. Now, what about those in sequence? So what are we talking about here? Well, getting rid of debt. That was stage 1. That is a higher priority now that we've got interest rates rising, inflation stubbornly high in the UK. So people should prioritise paying down debt. And the reason is partly that a handy little thing I've referenced before a few times called the rule of 72 says that if interest rates are at, say, 10%, inflation's at 10%, for argument's sake, slightly artificial example, left to roll up after 7 years, the value of debt, were you not to chip away at it by trying to pay some off, could double. So in other words, compound interest left to run at 10% in a high inflationary environment could see debt doubling. And if you're thinking 10% sounds a bit punchy, isn't the base rate a lot lower than that? Well, yes, it is, but think about credit card debt, think about unsecured loans where the interest rate could easily be double, even the 10% I'm suggesting. So paying down debt is key stage 1. Stage 2, get that emergency fund set up. Now I've got other videos that talk about how much that emergency rainy day fund should be for the leaky roof, for the child that suddenly needs a short-term loan and so on. But I'd suggest 3 to 6 months worth of your expenditure on a monthly basis if you're single, and 6 to 12 in the current climate if you're responsible for funding a family is probably about right. Things can go wrong, people lose jobs, get ill and so on. Having that cushion is reassurance that you can sleep well at night. Now, foreseeable calls on capital, key stage 3. This is all about mapping into the future your key goals, estimating when they're going to fall, how much they're going to cost. Cash flow forecasting can help here, and basically trying to work out what amount you're going to need and when you're going to need it. Now, there's a degree of estimation involved here, but most people can forecast, for example, when their kids may or may not go to private school, 8, 11 or 13 for argument's sake. So when the cost of having to fund that fairly expensive project might start to kick in. Most people have an idea of when they might be able to afford, if they're in that position, a second home or a holiday home or somewhere they're going to split their life after work, conventionally known as retirement. All right, so key stage 3, foreseeable calls on capital, is about identifying and then funding those what you might call medium-term objectives. And then what's left, key stage 4, are called lifetime savings. And the rules of thumb here are, here we're investing for the long term. This is potentially intergenerational wealth. This is long-term wealth. We're not going to draw down on it as a sort of cash point machine in an emergency. We don't need it in the medium term because we've identified our foreseeable calls on capital. So we can let that run, let it ride out the volatility of the equity market, for example, and hopefully take the long-term compound growth that such an approach can give us. So it's a long-term approach. We want to do it as tax efficiently as possible, using things like ISAs, using things like SIPs, for example. We want to identify how long we're going to be accumulating wealth to get to peak savings, and then when we're going to be decumulating on the other side. And we all want to be thinking about tax all the way through this exercise. So takeaways then from this short video would include starting as early as possible. Everything I've said, the quicker you do it, the better. Making sure you review your lifestyle, your objectives, and whether the rules are changing, the tax rules, for example, on a regular basis, so that you can maximize the strategy that sees as much money as possible, working as hard as possible in equities as part of that lifetime savings pot. Now, if you'd like to find out more about a lot of the topics I've just covered, emergency funds, foreseeable calls on capital and so on, my library at killick.com/learn is not a bad place to go. If you'd like to read all about it, there are my guides. One of them is called How to Invest in Equities, editor at killick.com for that one. And if you'd like some sort of more businessy context around this stuff, practical context, then Confident, that blue magazine with a pink sail in the middle, that's editor at killick.com too.